Most people believe banks love investors. After all, investors are the ones buying assets, taking risks, growing money, and playing the game, right? But here's the quiet truth no one tells you. Banks don't actually reward risk takers. They reward predictability. And once you understand this, you'll realize why two people with the same income can be treated completely differently by the financial system, and why one quietly gets better rates, better approvals, and more leverage, while the other keeps getting no. Right here, we're breaking down the quiet rule banks never advertise, why savers are treated better than investors, and how this rule shapes your financial future, whether you realize it or not. Let's start with a simple story. Imagine two people. Same age, same city, same salary. Let's call them Alex and Jordan. Alex is an investor. Jordan is a saver. Alex reads books about wealth, watches videos about stocks, real estate, and side hustles. Alex puts money into ETFs, crypto, rental properties, maybe even a startup or two. Money comes and money goes out. On paper, Alex's net worth might even be higher. Jordan does something far less exciting. Jordan saves. Consistently. Quietly. Every month. Money moves from paycheck to savings account. No drama. No big wins. No big losses. Just boring, steady accumulation. Fast forward 5 years. Alex applies for a mortgage. Jordan applies for the same mortgage. And here's where the quiet rule shows itself. Jordan gets approved faster. Jordan gets a lower interest rate. Jordan gets better terms. Alex gets questions. Can you explain these deposits? Why does your balance fluctuate so much? Can you provide additional documentation? Alex is confused. I'm building wealth, Alex says. I'm taking initiative. But the bank doesn't see initiative. The bank sees unpredictability. This is the first uncomfortable truth. Banks are not impressed by how smart you are with money. They are impressed by how boring you are with money. Because banks are not wealth-building institutions. They are risk management machines. Everything they do, every approval, every interest rate, every credit decision, is designed around one question. How likely is this person to behave exactly the same tomorrow as they did yesterday? And savers answer that question better than investors. Here's why. Banks don't make money by betting on upside. They make money by avoiding downside. When you save consistently, you demonstrate something banks value more than ambition. Behavioral stability. A saver shows predictable deposits, stable balances, low volatility, emotional control. From a bank's perspective, this signals this person will pay us back on time, every time. An investor, on the other hand, shows large inflows and outflows, irregular balances, transfers to external platforms, risk exposure outside the bank's control. To you, this looks like growth. To a bank, it looks like uncertainty. And uncertainty is expensive. Let's talk about credit. Most people think credit scores measure how good you are with money. They don't. Credit scores measure how profitable and predictable you are. That's why someone with a modest income but perfect payment history can have better credit access than a high-income investor with fluctuating balances. The system quietly rewards consistency over creativity, stability over strategy, discipline over intelligence. This is why savers often get lower APRs, higher limits, easier approvals, not because they're richer, but because they're safer. Now here's where it gets uncomfortable. Banks don't just reward saving. They penalize visible risk-taking. When you move money frequently, especially out of traditional banking systems, you're signaling independence. And banks don't like independence. Think about it. Money sitting in a savings account is visible to the bank, is measurable, is controllable, can be used to assess future lending. Money invested elsewhere leaves their ecosystem, reduces their leverage, introduces external risk. From the bank's perspective, savers are cooperative. Investors are unpredictable. This is why many investors feel like the system is working against them. Because in many ways it is. The system wasn't designed to reward financial creativity. It was designed to reward compliance. Not obedience, compliance. Do you behave in ways the system understands and can model? Savers do. Investors often don't. Now, this doesn't mean investing is bad. It means the system treats how you move money differently than how you grow money. And this is where many people get trapped. They invest aggressively, but neglect their bank profile. They build assets, but look risky on paper. They grow wealth, but struggle to access leverage. And leverage is where real acceleration happens. Let's talk about leverage. Banks don't lend based on dreams. They lend based on patterns. A saver creates a pattern the bank understands. An investor creates a pattern the bank questions. That's why many wealthy people quietly maintain large cash reserves, even when it's not optimal from a returns perspective. Not because they love low interest, but because cash buys credibility. Cash makes banks comfortable, and comfort unlocks options. This is the quiet rule. Banks reward the behavior that protects them, not the behavior that grows you. Once you see this, you start noticing it everywhere. Why people with money still keep savings accounts. Why wealthy investors still maintain boring financial habits. Why discipline is often more valuable than brilliance. But here's the twist. The people who truly win, they understand both sides of the system. They don't choose between saving or investing. They separate them. They maintain clean, predictable banking behavior while investing quietly elsewhere. They look boring to the system while building wealth outside it. And this is where the story changes. Because once you understand the quiet rule, you can use it. Imagine walking into a bank not as a risk, but as their ideal customer. Predictable, stable, disciplined, while behind the scenes, your money is working harder than ever. That's how leverage is earned. That's how doors open. And that's how the system stops working against you and starts working for you. But here's the part most people never learn. There's a specific way banks rank savers internally, and a hidden threshold where your treatment suddenly changes. It's not about income. It's not about net worth. It's about a number most people never track. And once you cross it, the system treats you very differently. Banks don't reward intelligence. They don't reward hustle. They don't even reward wealth the way you think. They reward predictability. And we ended on a cliffhanger. A quiet line inside the system. A threshold most people never see, never track, and never cross intentionally. Because once you cross it, your relationship with money changes. Your relationship with banks changes. And the rules stop feeling random. So let's pick up exactly where we left off. Banks don't just look at you as a person. They look at you as a profile. A living, breathing data model built from your balances, your behavior, your timing, your patterns. And within that model, there are tiers. Not public tiers. Not something they advertise. Internal tiers. Most people believe banks rank customers by income. They don't. Income is noisy. Income fluctuates. Income can disappear. Banks rank customers by control. Specifically, how much money does this person keep accessible, stable, and visible to us consistently? This is where savers quietly win. Let's talk about the first invisible tier. This is where most people live. Tier 1, transactional survival. Money comes in. Money goes out. Balances stay low. From the bank's perspective, this person lives paycheck to paycheck, has no buffer, is vulnerable to shocks. Even if they invest, even if they hustle, even if they're smart, the system sees stress. And stress equals risk. Tier 2 is where things shift. This is the buffer zone. At this level, a person consistently holds several months of expenses in cash. Not once. Not occasionally. Consistently. This is the first point where banks start treating you differently. Why? Because this tells them something critical. This person can absorb life without defaulting. Emergencies don't break them. Minor income disruptions don't scare them. This is where approvals get easier. Not because you're rich, but because you're resilient. Then there's Tier 3. This is the tier most people never reach and don't even know exists. This is where banks quietly change tone. This is the strategic saver tier. At this level, cash balances stay well above emergency needs. Deposits are consistent. Withdrawals are intentional, not reactive. From the bank's view, this person is no longer just safe. They are valuable. Because now, You're not just unlikely to default. You're a potential leverage engine. Here's the part that surprises people. Banks don't want you broke, but they also don't want you independent. They want you comfortable, but connected. And strategic savers fit perfectly. You have money, but you still need access. You still use products. You still play inside the system. That's when offers start showing up. Pre-approvals, lower rates, higher limits. Not because you asked, but because the system flagged you. And then there's the final tier. This is the tier almost no one talks about publicly. This is where the rules truly change. The quiet elite tier. This is where your money behavior signals something powerful. This person does not need us, but chooses to work with us. At this level, banks don't see you as a risk. They see you as a partner. They don't push products aggressively. They don't question every move. They don't nickel and dime you. They respect you. Because respect in the financial system isn't emotional. It's mathematical. Now here's where investors get confused. Many investors technically have the wealth to be in higher tiers, but their behavior keeps them classified lower. Why? Because their money is invisible. It's volatile. It moves constantly. It leaves the system. The bank can't model it. And if it can't be modeled, it can't be trusted. This is why two people with the same net worth get different treatment. One holds cash strategically. The other deploys everything aggressively. One looks stable. The other looks exposed. Same wealth. Different behavior. Different outcomes. Here's the quiet mistake many ambitious people make. They optimize only for growth and ignore presentation. But in the financial system, presentation matters. Not how flashy you are. How predictable you are. This is why wealthy individuals don't abandon saving. They refine it. They don't see savings as lazy money. They see it as insurance, leverage, credibility. Cash isn't just safety. It's signal. Think of savings as your financial resume. It doesn't show how creative you are. It shows how reliable you are. And banks hire reliability. Now let's talk about the quiet strategy the system doesn't teach. The people who don't choose between saving or investing. They separate roles. They let savings handle stability, credibility, access, and they let investments handle growth, upside, wealth creation. They don't mix the signals. They don't confuse the system. They look boring while building aggressively behind the scenes. This is why many financially successful people appear conservative on paper. They don't fight the system head-on. They flow through it. They give banks what banks want to see, so they can extract what they want in return. And here's the part most people miss. Once you cross into higher saver tiers, your cost of money drops. Interest rates improve. Terms loosen. Access expands. Which means every investment you make afterward becomes more powerful. Not because the investment changed, but because your foundation did. This is how quiet wealth is built. Not loud wins. Not viral trades. Not risky bets. But alignment. Behavior aligned with the system, while strategy works beyond it. So what's the real lesson here? It's not don't invest. It's not just save. It's this. Master how you are perceived by the system you rely on. Because the system is always watching, always scoring, always ranking. And once you understand the rules, you stop fighting ghosts. Let me leave you with this. Most people are trying to escape the system, but the people who win learn it, leverage it, and then quietly outgrow it. They don't rush. They don't rebel blindly. They don't move emotionally. They move intentionally. Note, read this carefully. If you feel like the financial system has been unfair to you, it's not because you're incapable. It's because no one taught you the rules. You are not behind. You are not broken. You are not bad with money. You are simply playing a game without the instruction manual. Now you have it. And once you understand how banks think, how systems rank behavior, and how quiet discipline unlocks loud results, you stop reacting and start positioning. That's when everything changes. If this changed how you see money, the system, or your own habits, you'll want to be here for what comes next. This channel isn't about hype, shortcuts, or get-rich-quick stories. It's about understanding the rules, building leverage, and growing quietly on purpose. Subscribe to Passive Wealth Explained. Because the people who win long-term aren't louder. They're better informed.